The end of the year may still be 2.5 months away, but never, never too early to think about ways you can save on your taxes and put some strategies in place now that could save you big time come next April 15th. Joining us live in our studio with tax tips that may add thousands to your bank account, certified financial planner Paul Miller from SageMark Consulting. Mr. Miller, welcome. Good to see you.
Hello, Tyler. How are you?
You know, it's a happy circumstance when investors actually have gains, and many of them may well have some capital gains this year. Your first tip, though, and boy, we've probably all got some losses left over. You want to realize investment losses to offset gains, right?
That's correct, Tyler. And especially if you had gains before May 6th. Because before the new tax bill, those gains are going to be taxed at a 5% higher rate. So if you can realize any losses this year, you can offset those gains.
Now, if I take a capital loss, I can offset 100% of my capital gains, right? I'm up to the amount of my loss. Plus, what is it, $3,500?
No, plus up to $3,000.
Up to $3,000 against my regular income in this year.
Correct.
A lot of people will take losses to do this tax thing, but I would bet you would say that taxes is not a reason to sell, right?
Correct. You want to take a look at your portfolio. If you have some positions that you would like to realize the losses, it makes sense to take those losses, and as you said, you can offset your current capital gains. You can use them to offset up to $3,000, which if you're in the highest tax bracket could be over $1,000 of tax savings. Now, let's say you own a stock fund that's invested in growth stocks, and you like that market sector. You can sell that fund, take the losses, and invest in a like fund that invests similarly.
I got us out of order. We were actually supposed to talk first about maximizing your 401k and IRA contributions. If you haven't opened an IRA, you can do so, a Roth or a conventional or a 401k.
Well, the number one way to save taxes this year is to maximize and take full advantage of your retirement plans. For most of us, that means our 401k plans that we have with our companies. This year, the maximum contribution has been increased to $12,000.
Yeah.
And if you are over 50, you can actually defer up to $14,000.
That's a very good strategy. That reduces your income dollar for dollar, and you're making tax-deferred earnings on that money. Let's move on to number 3, which is defer income and maximize deductions. In other words, you want to pull deductions, any you've got, into this year. So if you have elected expenses, elected medical procedures that might put you over the threshold for medical deductions, do them now, right?
Correct. And now the defer income, that's really for people who are self-employed or have control over bonuses or commissions. If you can defer that money into next year, again, I would check with your tax advisor to see if it makes sense, but it would be better to pay the taxes later than sooner. So
if I do some work for hire, I don't want to send that bill out until after the first of the year if I can avoid it, or have them pay me after the first of the year, then I get a year's free use of that money.
Correct.
All right, let's move on to estimated state taxes. These are people who have freelance income or independent businesses. Pay those before the first of the year, even though they're not due until.
This is totally in conflict with what I just said about deferring income. In this case, you want to accelerate paying those taxes, because if you pay them before December 31st, you can use those to offset your 2003 federal income.
Your 2003 federal income, if I pay the bill, date it before December 31st.
Before December 31st.
Get it in the mail, get it on the way for my estimated state tax, not my estimated federal tax.
State tax, absolutely.
The last one we have here, we've said give away annual exclusions. It really is give away money to lower the size of your estate, right?
Correct. Everyone knows the top federal tax rate is 35%, but the top estate tax rate, or it's now commonly known as the death tax, is 49%. So if you are going to be subject to that tax, it makes all the sense in the world to give away your annual exclusions, which is $11,000 per year. And most people do that to the children and the grandchildren, either outright or in trust.
So $11,000 a year in gift to avoid the federal gift tax, and then it reduces the ultimate estate tax you may or may not owe. Paul, we got to leave it there. Thanks very much. Paul Miller, certified financial planner at SageMark Consulting. Nice to be with you.